Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Michael Normyle, U.S. Economist at Nasdaq, and Chris Dearborn and Max Cabasso on the Nasdaq Market Intelligence Desk. We're here to discuss if earnings estimates are too high. And Chris, judging by the reaction out of some big tech earnings last night, I mean, we could see, the impact that it's having on the index today.
When you have higher expectations and the expectations don't deliver up to the near-term investors, you're always going to see a snap in the market, and that's kind of what we're seeing today between Alphabet, Visa, and Tesla. And there's commentary in there as well, though when you dig down a little bit, the numbers weren't really terrible for any company that was put out there. Just the expectations are coming in, I think it was last week, the week before, looking at 9.7% earnings growth for the quarter, which is a really lofty view when you look at where we were 3, 6, 9 months ago, when you're talking potential for negative earnings growth before, we'll call it the dovish pivot back in November-ish, right? And then as things start to move along better, you see euphoria moving into the marketplace a little bit, and I think we're a little bit ahead of ourselves. I think with the June 11th rally off of CPI kind of spiked the market as well, so a pullback is good. And I think that's where we are. Let's get through the first couple of big boys, but see where the rest of the market
comes. But we did get
comes.
through a couple. We had Tesla, we had Google, right? And while it beat on the top and bottom, it wasn't what consensus initially wanted, Max. And of course, that's going to hit other names like NVIDIA, Meta, Microsoft. I mean, there's a number of reasons for NVIDIA, but because of, we've been talking about this ad nauseum, where if you don't beat, and really beat the street in terms of guidance, it's going to bring it down.
Yeah, it's not a beat and meet quarter for a lot of these names. The way we've been trading, it's been that kind of just grind higher. The thesis has always been, hey, there's no news, all right, just buy stocks because they're just going to keep going higher. So that bar has gotten higher and higher. So that beat and meet, or even a small raise potentially, is probably not going to be enough. The expectations are so high that it's a beat and a big raise for future, for the final quarter of the year, the back half of the year, even to next year. You have to clear that high bar because, again, multiples have expanded. It's the show me story now. It's okay, we're here. How's this hitting my bottom line? And is the growth going to continue, where you're seeing this, that next quarter is going to be the same, the next quarter, and you're continuing to clear that bar because, again, the way we've traded, we were just at all-time highs before this recent pullback. We're up there. So now you got to show me.
Right, but you know what, Michael, in a way this almost seems rational. We've been talking about this, where you have this concentration of 6 to 7 stocks. The market's gains have been predicated on it. All of this has been priced into the names with this expectation that margins and growth and revenue are going to look somewhat the same. So this doesn't seem surprising to me.
Yeah, I think one of the interesting things out of the Google earnings yesterday was the spending on AI was $13 billion. People were expecting it to be $12 billion. There's a research note from Deutsche Bank this morning saying that the CEO of Anthropic said that the cost of training a model in the next 2 years could go from 100 million to 10 billion. And so are investors ready to make those kinds of investments? So, there's a lot of, the whole AI trade is a lot of expectations, and we have to see if they can be met and if the cost of doing it ends up being worth it.
Yeah, I mean, it's something that we cover frequently on the show from more of the cybersecurity risk management perspective, but it seems as if there were so many products rushed to go to market, so much, AI is nothing new, but let's call it the Gen AI applications being implemented in enterprise. And then it's almost like, okay, there's going to be cost associated at some point. There was a lot of valuation applied to these names, but the expectations that it wasn't like CapEx or anything was going to change. So would you say overall, though, outside of the tech sector, that earnings expectations perhaps were a little bit too lofty?
I mean, it's like you're saying, 10%, 9.7%. That's a big ask. The economy has been slowing, so we've seen consumers getting squeezed, especially on the low end. So as a whole, where is that demand coming from that you're going to get 10% growth? So it's definitely
Visa brought it out on their earnings call today. They're talking about the low-end consumer not using credit cards to purchase, and that's a big swath of their profitability, which goes to all the economic data that we've been talking about. And like we started talking about at the beginning of the year, the issuers were the ones who were talking about it took the economic data a few months to catch up to show a slowing consumer on certain levels, not all levels, but certain levels. And now you're seeing that carry through the Q2. So now the data and the issuers are only a few, but Visa's a good sample size here. They're not spending. If they're not spending, and the soft landing thesis is intact, even though retail sales look pretty good on the last report, the unemployment number is ticking up a little bit. Inflation is decreasing in certain areas. is the consumer going to be strong enough to continue to pull this economy forward, and we get GDP very soon.
Yeah.
So, it's curious to see if we can tie that together and say, yeah, looking forward. Again, remember, earnings are a look back. To Max's point, it's what they're forecasting for the rest of the year. And if the forecasts don't hit, it doesn't matter how well you did. I'm going to hit you because you're not going to make that much again.
Right. Well, I think this is interesting. I want to point out something that Deloitte wrote about in terms of consumer spend and credit card balances. What's unique about this situation, we are basically at pre-pandemic spend, but during the pandemic in 2020, those balances went down significantly because people weren't spending or they were using whatever money that was extra to pay those balances off. And then, of course, once the lockdowns eased, jobs were kind of, back again, we were coming back to work. Those credit card balances certainly regained that pre-pandemic equilibrium. So the unique circumstances around these events within such a short time, it really makes it hard to benchmark to previous periods. However, we are back to that pre-pandemic spend. But yeah, it's percentage too, what's worth then versus what.
But also remember, now you're also at a higher interest rate too. So now you're talking credit cards that are 20, 25, even higher percentage, right? So even if you have money, you don't have money currently to pay down your debt, that debt is growing substantially. And people just can't continue on that path at this level of interest rates.
Yeah, well, but Max, I mean, if we go to retail specifically, it's always the tales of the haves and the have-nots, right? LVMH weak, Hugo Boss cut guidance, Burberry warned, but your discounters, TJ up 20%, Costco up 29%. So with what's happening in the Mag 7 names and where consumers are focused on discount, does that set up the case for continued rotation?
I think so. I mean, it's that concept the trade down. So the spend is still there, the consumer is still there, but what they're choosing to spend their money on and how much they're choosing to spend on whatever they're allocating, right? It's that trade down. You see it in restaurants and now in these goods, and clothing where they're moving down a level to try to save a bit because of, again, the costs have continued to go up. That's the question I have is COVID threw a wrench into everything. It's very unique. Kind of the cause of the inflation compared to previous times. I mean, we were just flush with cash. Like you said, debts were paid down, people weren't spending, they had all this money, and now it's kind of back to where it was. So now is the consumer beginning to get exhausted, right? There's a bit of that exhaustion factor. We talk about housing frequently, the cost of housing, not just if you own, but cost of rents as well, where all those things have added up, and the consumer's been able to handle that for the past year, 2 years, as they kind of had those savings built up. We were flush with cash. And now, okay, credit card debt's starting to pick back up. Where is the consumer? And that's where they're starting to make those decisions. All right, you know what? I'm going to go down one level and not spend as much as I did because I need it elsewhere. I want to save up. I think anybody that's renting, that's looking to buy, maybe they're down trading a little bit, say, I'm trying to save up a bit more to get a down payment down on a house. The costs have continued to go up. I'm going to be a bit more, wise about where I choose to spend that money and kind of just, again, downgrade that have that little delta of savings there.
Well, Michael, let's talk about this for a moment here, putting things into context. June existing home sales fell to 3.89 million. In 2019, that was well above 5 million.
Yeah, right. I mean, the housing market's still one of the real pandemic legacies that we have, where it's still really frozen from where it was early on in the pandemic. So, high rates, high prices, lack of supply, people aren't buying. It's really expensive to buy a house, so the demand aspect isn't really there. So it's just really a tough market right now, and it's going to take a while for it to normalize. Even if we start, the Fed cuts 25 basis points, is that really going to change housing demand? Probably not. It's not going to make a big difference in terms of what mortgage rates are. And then, the flip side of that is that when people aren't buying homes, that means people aren't spending on furnishings, they're not spending on renovations, so that's a drag on those sectors too.
Right, I would argue that supply is a bigger issue here, right? Because when you think about it from a historical context, interest rates are not that ugly. It's just we were so used to, a near zero interest rate for so long. But if there's no supply on the market, it's not going to move no matter what you do with rates. Plus, Max, with all that pent up demand, right? I mean, if they were to move lower, let's even call it 1%, it'll be almost like a feeding frenzy for whatever supply's out there.
The supply, again, like you said, the supply's limited, and even the supply that's out there, it's at prices that are elevated, right? So if rates fell, percent, maybe the affordability for the buyers, I can afford this now, but again, with that limited supply, you used to have 5 people looking at the house in current environment, maybe you're at 10, 15, 20, the prices are then going to go back up. So it's one of those things, is it a limited window when they cut before prices then continue to go even higher, and that takes you out of that affordability range again. So it's going to be tough to kind of get out of this window of finding an affordable house for people, that middle range. The average cost, I think it was $427,000 for a house now in the United States. So again, as rates come down, you'd expect prices to go even higher, unless we get a huge, a ton of supply coming to the market that'll, bring that down. The prices are going to go higher, and affordability is still going to be a problem.
Well, Chris, I have a question for you. So you cover consumer on the Markets Intelligence Desk, and I remember you saying, 6 to 8 months ago that the issuers you spoke to, they were getting nervous about the consumer even then, right? So they're always looking 6 to 8 months, a year ahead. Are you starting to hear that narrative improve, where they're thinking? Okay.
No,
I mean, I think that's a key point.
Not at all. Though my sample size is limited right now because most of the issuers are in the quiet period ahead of, remember, retail generally reports towards the end of the cycle as opposed to the beginning. I will say that nothing has really changed on their narrative, and some of them are even more concerned now about merchandise supply, depending on what happens with the election. Right? You're going to see easing of a couple of items that the Republicans take it, but there's also a threat of tariffs on China. A lot of them do source from China. So there's also concerns there as well. So if they have consumers not spending and the merchandise is more expensive, what are you going to be doing with that? So they're getting questions about that as well, but they're not giving answers yet. So I guess we're going to have to wait to see what they say on the next call.
So Michael, I have an interesting question for you in terms of the economic research that your team conducts. With things have shifted so quickly in the political landscape over the past couple of weeks. Does that throw a wrench into any of your theses, or is it challenging because policy is just not discernible at this point?
I think the real challenge is that, especially with this election, it's not going to matter just who wins the White House, but who wins Congress too, because if we see a red wave, then there's a chance that we see some more inflationary policies getting through, like those tariffs that you're talking about, restricting immigration. That's something that's going to reduce labor supply, so put upward pressure on wages. Fiscal expansion, all these kinds of things have the likelihood that they'll be inflationary, and so that could, throw a wrench in the Fed's rate cut plans if they need to keep a lid on inflation because of those policies. But if we see divided government, then that might not come to pass. So it's not just who wins the White House, whether it's a Democrat or Republican. It's the ultimate result of Congress too. So it's
so split ticket would probably be the best
safest
scenario.
bet. Yeah.
Right. Well, I think the confusion is for businesses as well, whether they think about investing or expansion. There really is no clear policy. It's not even like, okay, if so-and-so gets in, more business friendly, or vice versa. I mean, we saw what happened when they were talking about Harris getting the nomination and how she is tech friendly, right? So on Monday we saw what happened with the tech stocks, which you thought it would have kind of been a reversal because of how typically more business-friendly Republicans tend to be. And that's got to be really challenging when it comes to business planning.
We need to see more out of Harris and what she's going to be saying and doing, right? So it's the first time since she went on the campaign trail where she's got the full nomination. Before, she was looking for the Democratic nomination. And she's been kind of in the back seat for a while behind Joe. And we need to see what she's going to say, where her stances are, and more importantly, what the mentality is for her towards business. And if she's as liberal as Joe has been, then you know what you're going to get. You're going to get more of the same. If she's a little bit more tech-friendly and business-friendly, being from California, especially ties with those companies, and gets a little bit more conservative, she may lose part of her vote there, especially those who are extreme to the one side. I need to hear and see more. I don't think there's enough of a sample size out there yet.
Yeah, and she's a presumptive nominee.
Correct.
At this point,
At
not
this
that
point.
she's actually secured it. She wants to make that clear. Max, just to wrap up here, any thoughts from you? It's got to be really challenging to give an intelligent thought on the outlook.
There's a lot going on. I'm interested to see and hear from some of the internet companies that actually handle web traffic, that have a good picture into kind of what they're seeing. They've been typically, even a year or two ago, they've been pretty good with calling
The betting sites are better than the polls, honestly.
Betting sites, but also with just consumer data and seeing kind of where traffic is going, how people are accessing the internet, where they're looking. They've been pretty good to call out some storm clouds ahead, well ahead of economic data, of consumer data. They can actually see the very beginning of it and the traffic and how things are actually looking. And they've been a pretty good indicator on how things have turned out. I think it was a year or two ago, they were really cautious about things, and that's when we started to see some cracks. Then this last quarter, you're starting to hear a bit more. They're cautious, not like it was 2 years ago, but they're cautious. So I'm interested to hear what some of them have to say, because again, they've been a pretty good indicator of what they're seeing in the guts of the internet, essentially, and kind of where people are looking, how they're buying, what sites they're frequenting, and is a good barometer. So that's one that potentially is a canary in the coal mine to hear what they have to say, where it's not a normal thing where we're looking at consumer spend or tech spend. They have a pretty good idea, and it's kind of outside your normal bubble of information.
Right. All right. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.